Okay guys, let's have a look at bond yields and the currency markets, because we had been seeing the US dollar get very strong against the Japanese yen before a recent pullback. We had been seeing the US dollar get stronger against the Swiss franc before a recent pullback in price. As we can clearly see, a very strong dollar since the beginning of the year. We saw the dollar getting stronger against the euro until a recent pullback in price as well. As we can clearly see from the beginning of the year, we've had a pullback since. And the pound was doing exactly the same thing as the US dollar. We saw the pound getting stronger against the Japanese yen, as we can clearly see. We saw the pound getting very strong against the Swiss franc, as we can clearly see from the beginning of the year. And the fundamentals behind this trade was because of bond yields in the US and the UK rapidly rising because of the growth expectations and higher inflation expectations from the markets. So the UK government and the US government have been pumping a lot of money into their economies to try to help people deal with the pandemic. And now that they was vaccinating their people at a faster pace than the rest of the world, investors was betting that inflation in the UK and the US would be quite rapid when the economies reopen. So they were selling bonds to cause the interest rate to rise, and that was causing money to flood into the UK and the US, because investors who want to park their money into a specific part of the market without taking risks, they buy government bonds because you're guaranteed to get your money back from the government plus some interest at the end of the maturity of that bond. And therefore, when you look at European bonds compared to UK bonds, US bonds, the interest rates in the UK and the US are much higher than in Europe, because the US and the UK central banks allow the markets to freely dictate where the level of interest is on the bond, because they allow the markets to buy and sell bonds freely, whereas Europe has been pinning their interest rate near zero to allow countries like Italy, Greece to borrow money through this pandemic at low rates of interest. And they don't want the bond yields to rise because it can indebt them even more and cause their interest payments on their debt to rise even further when they're already very heavily indebted at this moment in time. So what this has basically meant is, as the US interest rate has been going higher, so from the beginning of January, you've been seeing the US interest rate go from around 0.90% up to 1.5%. You've seen, since the US interest rate has been going higher, the US dollar getting stronger. As you can clearly see from the beginning of January, the bond yield was rising aggressively. And if you compare this bond yield to, say, the German bond yield, which is the benchmark treasury yield in Europe, you can see that the German interest is minus 0.25%. So there's a massive differential between the European bond interest rate and the US bond interest rate. Same for Japan. As you can clearly see, when you look at Japan's interest rate, it is very low at 0.06, so nearly 0%. So investors in Japan, investors in Europe was looking at the United States and thinking, this is a very attractive place for me to park my money because I can get 1.6% interest on my money compared to 0% interest in Japan, 0% interest in Europe. And that's why you saw the US dollar getting very bullish against the Japanese yen during the period of higher bond yields. That's when the dollar took off against the yen and started to strengthen in the markets. It's exactly the same for the UK 10-year yield. You can clearly see the UK's interest rate from the beginning of the year was going higher, and it's now gone from 0.2% up to 0.74%, and that is at exactly the same time when the pound was getting stronger against the Japanese yen. It's started to take off from the beginning of the year, and that's the fundamentals behind the pound and the dollar getting stronger against countries with a lower interest rate. So here's a spreadsheet where we look at the differential between one country's interest rate compared to another country's interest rate on the bonds, and you can clearly see when you have the US bond yield minus the Swiss francs, the Switzerland's bond yield, you have the difference, and if the difference is positive, then you see the US dollar follow the difference in the exchange rate. You can clearly see the exchange rate follows this yield quite closely. So when the yield is rising, you see the dollar getting stronger against the Swiss franc. When the yield starts to decline, you see the Swiss franc get stronger against the US dollar, and they literally move with each other. And you can look at this with any currency pair. It's all about the differential in yields, because that's where the money is going to be flowing between two countries, because investors always want to receive the highest interest rate possible in the markets with the lowest amount of risk. Okay, so you can clearly see they closely follow each other and they correlate each other in the markets. Now, with the US's $1.9 trillion stimulus package that's just come through this year from the Joe Biden administration, and he's planning another $2.5 trillion of infrastructure spending, they're saying, the markets and the analysts, that the US interest rate is likely to go up to 2%. So if this recent pullback then goes back higher, back towards 2%, on the interest rate, and the reason it will go to 2% is because investors want to be compensated more interest for the risk of inflation. So if you look at the US dollar, Japanese yen, you've seen a pullback in price recently, as we can clearly see here, but this is because, as we can see here, recently we've had a pullback in price of the US bond yield. So the bond yield has gone lower, and that happened from around the 30th of March, and there's no surprise that if you look at the USD Japanese yen, it's around this date as well, around the 30th of March, as you can clearly see here, that the dollar started to weaken against the yen. So literally the bond yield is dictating the move in the US dollar yen exchange rate. So that's what we have to monitor very closely, because that's what's going to be driving the dollar forward. It's all about bond yields. Very important to understand for us. So it's not just the dollar and the pound, it's exactly the same for the Canadian dollar. We've seen the Canadian interest rate going higher in 2020, and there's no surprise that as the yield on the 10-year government bond in Canada was going higher, exactly the same situation was playing out, where we had, for an example, the Canadian dollar being very bullish against the Japanese yen from the beginning of the year. For an example, we saw the Canadian dollar getting very bullish against the euro, for an example, since the beginning of the year. So it's all about bond yields, guys. This is what it is to make the currency markets move. So if we're going to be trading the dollar, if we're going to be trading the pound, if we're going to be trading the Canadian dollar, what we have to be doing is paying attention to the bond yields. And if they start rising, we start buying the Canadian dollar, buying the pound, buying the US dollar, and we buy these currencies against the yen, the Swiss franc, the euro, because these countries have extremely low interest rates, and their central banks are keeping them low on purpose because they need to try to drive up growth, and they don't want the governments having to pay too much interest on their debt that they've borrowed to generate that growth. So that's the most important thing to understand, guys, because that's what's going to be driving the markets, and that's what we have to pay attention to. It's exactly the same if you look at Australia, for an example. Let's look at the Australian 10-year bond, 1.6%. Again, it took off from January this year, and again, no surprise, the Aussie dollar got stronger against the Japanese yen, as you can clearly see here, or you could see why the Aussie dollar was getting stronger, for an example, against the euro. You can see it here again, the Aussie dollar getting stronger. So guys, hope that makes sense. That's the currency markets. That's what we have to look out for, and hopefully that makes a good idea in your mind about how to trade the currency markets and what you have to be looking out for, most importantly, moving forward. Thank you.